Warren Buffett and Berkshire Hathaway.
Warren Buffett is doing.
Warren Buffett's Berkshire Hathaway.
Buffett is investing in
Warren Buffett.
Warren Buffett.
Warren Buffett.
Warren Buffett.
Buffett.
Warren Buffett.
For many people, investing in the stock market and picking stocks may seem hard, but it doesn't have to be. Enter Warren Buffett, who's made it look easy for the last 80 years.
His effortless approach to investing has proven time and again that you don't have to be a genius to make money in the stock market.
So you're telling me there's a chance?
In this video, we're going to go through some of the strategies that have helped him become one of the most successful investors of all time.
It all began in 1942 for Buffett when he made his first investment in the stock market.
on this March 11th in a couple of weeks. It'll be 77 years since I bought my first stock. And I paid $114.75 for 3 shares of City Service Preferred.
Throughout his teenage years, Buffett read numerous books and tried several different investment techniques. Then, in 1949, as a student at the University of Nebraska, he read The Intelligent Investor by Benjamin Graham.
This book taught him the importance of long-term investing and ways to minimize risk. It had such an impact on his life that he enrolled at Columbia after learning that Graham was a professor there.
I've had some lucky days in my life, but one of the luckiest was in 1949 when I was 19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor. It not only changed my investment philosophy, it really changed my whole life. I'd be a different person at a different place if I hadn't have first seen that book. I got a bedrock of investment philosophy that really hasn't changed ever since I read the book. I may embellish on it a little here and there, but it was Ben's ideas that sent me down the right path.
Influenced by Graham, Buffett took to the investing world with most of Graham's investing strategies, and we're going to go through them in this video.
Let's get right into it with Buffett's first investment strategy, which is value investing. This strategy is simply finding stocks that are undervalued by analyzing several factors within a company.
These include determining a company's intrinsic value by evaluating the company's financial performance in areas like cash flow, PE ratio, and return on equity.
He also looks into fundamental factors like business model, brand power, and future potential. Understanding these details about a company gives him a clear outlook on the value and potential growth of his investments.
Buffett is not only known for value investing, but he's been on stage numerous times preaching this strategy.
I was taught to buy very cheap stocks, so I'd look at the numbers and I ended up buying what I call cigar butts. They were stocks that were so cheap. They were like finding a cigar butt. It might look kind of soggy and unpleasant, but it had one free puff left in it. And so, but the problem with that, of course, is you take the free puff and then you have to go around looking for another cigar butt. And finally, I had a partner that straightened me out, and it told me that it was much better, as Butard quoted, to buy really wonderful businesses at a fair price instead of looking around for these things that had one puff left in them.
Just because a stock is cheap doesn't necessarily mean it's a good buy. His approach is to get the best value for every dollar you spend without sacrificing the quality of your investment.
This next strategy is to invest in what you know and don't worry about companies outside of your circle of knowledge. Many people make the mistake of buying investments that they don't fully understand.
You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "Well," he said, "you can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities. And only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike.
It's no question that Microsoft is an excellent company and a solid investment, but Buffett didn't invest in it because he didn't understand computers at the time.
Did he miss out on a great investment opportunity? Absolutely. But it's far better to know the ins and outs of a company before you invest in it to mitigate your risk.
This is an important part of his investment strategy. As a guy who eats burgers and drinks pop almost every day, Coke was something that he did know, and this is why Buffett invested in Coca-Cola.
He believes in the value of Coke as a long-term hold because of its simple business model, good management, and quality products.
This brings us to his next investment strategy, which is long-term investing. By buying and holding stocks for a long period of time, a well-run company will most likely increase in value.
This long-term approach results in higher returns by maximizing potential compounding interest while also reducing the added fees associated with tax and trading. Additionally, holding on to high-quality investments reduces the risk of short-term price fluctuations.
If we look at Buffett's wealth, 90% of it has been gained after the age of 60. This sounds unbelievable when you think back to his investing start as an 11-year-old in 1942. But this is the power of compound interest.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
Buffett's wealth has been growing at an incredible rate in his later years, which is just more proof that investing for the long term is easily one of the best strategies.
Moving on, Buffett's next strategy is to keep cash on hand to deploy when an investment opportunity arises, especially in a bear market.
Buffett loves when markets are down, as it provides a rare opportunity to buy stocks at a discount, and we know that Buffett loves undervalued stocks.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
Buffett once said, "Opportunities come infrequently. When it rains gold, put out a bucket, not a thimble."
Another strategy not often used by Buffett is to know when to get out of an investment. Buffett hates selling his stocks, but if a better opportunity is available, sometimes it's worth it.
I sold, I think, roughly $1.5 billion or so of Johnson & Johnson stock. I wasn't selling it because I thought there was anything wrong with Johnson & Johnson. I just felt that the General Electric Preferred was more attractive, and I didn't want to leave myself in a position where I wasn't comfortable with the cash position that I would have had if I hadn't have sold that.
Another reason for selling a stock is if a business fundamentally changes or adopts terrible management. It may be wise to exit the position.
Companies will go through changes over time, and if they don't hold the same value or you don't believe in them as you once did, you probably shouldn't hold them.
The only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced. And that doesn't happen very often.
Our last strategy is one that Buffett thinks is the biggest problem with investors these days, which is emotional investing. Since 1792, when the New York Stock Exchange was created, people have been making bad investment decisions.
This is because they invest with their emotions instead of their heads and facts. You see it now as markets fluctuate or celebrities tweet about an investment, people react without putting any thought or research into their decisions.
Analyzing and understanding your investments will give you the confidence and peace of mind to hold when others are panicking.
What's the biggest mistake people make, though?
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. And for whatever reason people give you, you should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre of corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. If you buy an apartment house, you look at what the rentals will be and what the taxes and expenses will be, and then you decide how much income you'll have, and you pay a fair price for that. But you don't in stocks, people, their neighbor whispers something to them and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying, whether it's a farm, apartment house, or a company, but the company is represented by a stock. And if you always get your money's worth, you'll do very well.
To summarize, here's a quick look at the strategies we've covered. Value investing. Always look for stocks that are on sale.
Invest in what you know and stay within your circle of knowledge.
Invest for the long term. Plan to buy and hold.
Keep cash on hand to jump on any opportunities that may pop up.
Know when to get out of an investment. Don't hold stocks whose fundamental values have changed or if better opportunities become available.
And lastly, don't invest emotionally. Learn everything needed about your investments to give you the confidence during market volatility.
If you're still worried about picking quality investments, you can always choose an index fund. Buffett highly recommends index funds for the average investor because you can get a basket of great companies with a single purchase.
If you want some index fund options to get you started, you can check one of our ETF videos right up here.
And if you enjoyed this Buffett video, give us a like, subscribe, and hit that notification bell so you don't miss any of our vids. And with all that being said, he's Mike.
And that's Max. And we'll see you guys next week.
Happy investing.